It's the most seductive whisper in the mind of any market participant. The quiet, desperate prayer that begins the moment a trade turns against you. It starts as a simple thought. It's just a pullback. Then, as the numbers on the screen glow a deeper and more painful shade of red, that thought morphs into a more potent and dangerous emotion. It has to come back. This is the sound of hope, and it is the most expensive emotion you can ever entertain in the world of speculation. It feels like a safety net, a comforting belief that the laws of gravity will reverse just for you. But in reality, it is the anchor that will drag your account down to the depths, ensuring a catastrophic financial loss from which recovery is mathematically improbable. Hope is not a strategy. It is the final agonizing stage before an account blow-up. It is the voluntary surrender of discipline to wishful thinking. The market does not respond to your desires, your needs, or your hopes. It is an impersonal engine governed by the immutable law of supply and demand. When a stock's price is falling, it is not a random event or an unfortunate turn of luck. It is a clear, objective message from the market itself. The message is simple. There are more sellers than buyers. Supply is overwhelming demand. To hope for a reversal without any concrete evidence of a change in this dynamic is to argue with reality. Jesse Livermore, one of the greatest speculators to have ever lived, had a simple but profound mantra. Markets are never wrong, opinions often are. Your hope that a stock will recover is merely an opinion. The falling price is the market's fact. When your opinion and the market's fact are in conflict, the market will win 100% of the time. To hold on to a losing position is to bet your capital on your opinion being more powerful than the collective force of global supply and demand. This is not a battle you can win. The destructive power of hope is not just psychological. It is brutally mathematical. Let us consider the cold, hard numbers that govern capital. If you allow a position to fall by 25%, you do not need a 25% gain to get back to even. You need a 33% gain. If you indulge your hope and allow that position to suffer a 50% drawdown, your situation becomes dire. To recover your original capital from that point, you now need the stock to double. You need a 100% gain just to get back to zero. The deeper you allow a loss to run, the more you are asking for a miracle to save you. Professionals understand this unforgiving arithmetic. They treat small losses as a necessary business expense like paying rent or utilities. They are the cost of gathering information from the market. The uninformed participant, fueled by hope, treats a small loss as a personal insult, an error to be erased by waiting. In doing so, they transform a manageable business expense into a devastating capital erosion event. They are not trading. They are praying. From the perspective of market mechanics, a falling stock is exhibiting clear signs of weakness. Richard Wyckoff taught us to read the chart as if it were a story being told by the large operators, the smart money. When a stock that has been in a healthy uptrend suddenly experiences a sharp drop on high volume, this is a significant event. It is called a change of character. The easy upward momentum has been broken. This is the first warning sign. Hope will tell you it's a buying opportunity. Logic tells you that a significant amount of supply has just entered the market. The professionals are potentially beginning to sell, and you are thinking of buying their shares. After this initial drop, the price might attempt to rally. But notice how this rally behaves. It is sluggish. It moves up on lower volume than the preceding decline. It fails to make a new high. This is what Wyckoff called a last point of supply. It is the market's final feeble attempt to move higher before the next, more significant wave of selling begins. Hope blinds you to this weakness. It makes you focus on the small upward movement, whispering, "See? It's coming back." But the tape, the price action itself, is telling you a story of exhaustion and impending decline. Let's build a mental image of this process so you can recognize it without a screen in front of you. Picture a healthy stock in your mind. For weeks, it has been making a series of higher highs and higher lows. The price moves up in strong, confident strides and pulls back gently. Now, imagine a day where the stock opens normally but then collapses. The price bar for that day is long and red, and it closes at the very bottom of its range. Look at the volume associated with that day. It's a massive spike, far greater than the average volume of the preceding weeks. This is the change of character. It is a loud announcement that the dynamic has shifted. The next few days, the price tries to recover. It inches upwards, but the daily price bars are small and narrow. The volume dries up. This is the market showing you it has no energy, no fuel for a further advance. This is the weak rally to the last point of supply. Then, the confirmation arrives. The price rolls over and breaks below the low of that first big red bar. In Wyckoff's terms, the price is now falling through the ice. The last area of support has been violated. For the hopeful trader, this is the point of maximum psychological pain. They are now deep in a losing position, paralyzed by the fear of realizing a large loss and clinging to the only thing they have left. The hope that it will all magically reverse. But the evidence was there all along, written in the language of price and volume. Hope simply prevented them from reading it. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. So, how do we replace this destructive emotion with a cold, logical process? We must operate with a predefined plan, created when we are rational and objective, before our capital and our emotions are on the line. This is the path of the professional. The plan has 3 non-negotiable components: the setup, the trigger, and the protective stop. First, the setup. Before you even consider entering a trade, you must identify the price level that will prove your thesis wrong. This is your line in the sand. This is what Livermore called the uncle point. It is not an arbitrary number or a percentage. It is a structural level on the chart. If you are buying a stock because it has found support at a certain price, your stop loss must be placed just below that support level. Why? Because if that support breaks, the entire reason for your trade is invalidated. The market has told you that your premise was incorrect. The setup is your hypothesis, and the stop loss is the point of falsification. By defining it beforehand, you remove any room for in-the-moment negotiation, hesitation, or hope. You have a contract with yourself and with the market. Second, the trigger. The trigger for your exit is not a feeling of fear or panic. It is the unemotional event of the market price touching your predetermined stop-loss level. That is all. There is no debate. There is no waiting to see if it will bounce back. The moment that price is touched, your order is executed and you are out of the position. You have taken a small, manageable loss. You have protected your capital to play another day. The amateur trader sees this as a failure. The professional sees it as a successful execution of their risk management plan. They have honored their discipline. The goal is not to be right on every single trade. That is an impossibility. The goal is to ensure that no single trade can cause significant damage to your account. This is only possible if you cut your losses coldly and mechanically. Third, the stop loss itself. Let's be very clear about its function. A stop loss is not just a tool to limit financial loss. It is a tool to protect you from your own worst emotional impulses. It is the circuit breaker that disconnects your hope from your trading account. When the trade goes against you, the natural human tendency is to freeze. We are wired to avoid pain, and crystallizing a loss is painful. We would rather live in the uncertainty of hope than face the certainty of a loss. A hard stop loss placed with your broker automates the process. It takes the decision out of your hands at the moment of maximum emotional pressure. It forces you to be disciplined even when every instinct is screaming at you to wait, to hope, to give it just a little more room. The market rewards discipline, not hope, and the stop loss is the ultimate expression of that discipline. Now, let's address the most painful scenario that tests a trader's resolve, a situation that often sends them right back into the arms of hope. What happens when you honor your stop loss, exit the trade, and then watch in frustration as the stock immediately reverses and soars in your originally intended direction? This is known as being whipsawed, and it is one of the market's most effective psychological tortures. The feeling is one of being cheated. You followed your rules and you were punished for it. The temptation is to abandon your rules altogether, concluding that stop losses don't work. This is a fatal error in judgment. Let's analyze what likely happened from a market mechanics perspective. That sharp dip that triggered your stop loss before reversing may have been a Wyckoffian spring or a shakeout. These are deliberate maneuvers by large operators designed to do exactly what happened to you, to trigger the clusters of stop-loss orders resting below a key support level. They want to buy the shares of disciplined traders like you and of panicked retail participants at a lower price before they begin the real upward move. They are shaking the tree to make the weak hands fall out. Your exit was not a mistake. It was a consequence of a sophisticated market maneuver. You successfully protected your capital from a potential breakdown. The fact that it reversed was new information. The disciplined response to a whipsaw is not to abandon your rules. It is to wait for a new, lower-risk entry point. After a spring or shakeout, the price will often come back to test the area of the breakout. This test will ideally occur on much lower volume, indicating that the selling pressure has been exhausted. This secondary test provides a much safer and more confirmed entry signal than the original one. You exited with a small, manageable loss. You observed the market's new behavior. And now you have the opportunity to re-enter, with confirmation that the bearish move was false and that demand is now in control. You sacrificed a small piece of capital for a large piece of information. The hopeful trader, who would not have used a stop, might have panicked and sold at the very bottom of the move, or worse, held on through a genuine breakdown had the spring failed. Your process kept you safe and gave you a second chance. The process is everything. The other destructive path fueled by hope is the insidious tactic of averaging down. This is the act of buying more of a stock as its price falls, in the belief that you are getting a better average entry price. This is perhaps the single most dangerous mistake an uninformed participant can make. It feels smart. It feels like you are buying a bargain. But you are doing the exact opposite. You are reinforcing failure. Your initial position is already wrong. The market is moving against you. By adding to it, you are not reducing your risk. You are compounding it. You are throwing good money after bad, increasing your exposure to an idea that the market has already told you is incorrect. Livermore was unequivocal on this point. A speculator should never average down. Instead, the professional does the opposite. They pyramid their winners. They add to a position only when it is moving in their favor and showing them a profit. They add to strength, not weakness. Think of it this way. If you have a garden, do you water the weeds or the healthy growing flowers? Averaging down is watering the weeds. Each new purchase is an admission that the previous one was made at the wrong price. It is an act of ego, an attempt to force the market to prove you right. But the market has no interest in your ego. By averaging down, you are taking what should have been a small, manageable loss and transforming it into a position so large and so deeply negative that your account is now facing a catastrophic drawdown. Hope convinces you that the next purchase will be the one that turns it all around. Logic dictates that you are simply digging a deeper hole. In conclusion, the battle for success in the markets is waged primarily within your own mind. Hope, while a virtue in life, is a terminal disease for a trading account. It must be surgically removed and replaced with a rigorous, unemotional process. This process begins with accepting that you will have losing trades. They are an inevitable part of the business. The key is to keep them small. You achieve this by defining your risk before you enter, by placing a hard stop loss at a logical point of invalidation, and by executing your exit without hesitation or negotiation the moment your stop is hit. Do not argue with the price action. Do not believe that your personal conviction can alter the balance of supply and demand. Cut your losses coldly, efficiently, and without emotion. See it not as a failure, but as a strategic retreat that preserves your capital, your most valuable asset. A small loss is a tuition fee paid to the school of the market. A large loss born from hope is an expulsion. Your primary job as a speculator is not to make money, but to survive. And survival is only possible for those who conquer the seductive and ruinous power of hope. Master this, and you will have taken the single most important step on the path to consistent profitability. If you wish to understand more about the mechanics that govern these market truths, continue to listen. The lessons are endless for the serious student.